Hi everyone, so let's just get back to 2009 paper 1, questions 25 through to 30 here. Okay, so the country's central bank is charged by the government with setting interest rates with a view to meeting a given inflation target. What will increase the likelihood that it will decide to raise interest rates? So you can see I've highlighted that. Will it be an appreciation of the currency? Well, a further raise in interest rates would drive up the currency further. So no. An increase in the inflation target? Well, no, because then you'd want to reduce interest rates rather than raise interest rates. Okay, an increase in the country's trend rate of growth. Well, notice it says trend, and that's really, really important because it's not suggesting it's going above trend and therefore causing a nasty bubble or boom period to form in the economy. So no. An increase in the government's fiscal deficit? Well, yes, this would be the answer. So we're certainly looking at the answer right here of D. Okay, and the reason for that is because, of course, the fiscal deficit needs to be financed via borrowing. And how can you incentivize borrowing? Well, it's through higher interest rates, of course. Okay, so 26, the table shows the output per unit of input of two goods, X and Y, in two countries, 1 and 2. So which statement about the data in the table is correct? Well, we can see country 1 dominates in terms of the absolute advantage of production of X, as well as an absolute advantage here with regard to Y. We can see that the actual trade-off seems to be, 2 and a bit to 1 here, and 2 to 1 as a ratio here. Okay, so country 1 has an absolute advantage in the production of X. Okay, yes, well that's true so far, so we can certainly tick that. And a comparative advantage in the production of Y. Well, if they produce Y, they'll lose out on the world. Well, the world consisting of these two countries would lose out on 2 and a bit of X for every Y which is produced. That's not the case. Okay, so country 1 has an absolute advantage in the production of Y. Yeah, well, their number is greater, okay, and a comparative advantage in the production of X. Well, that fits the bill because that's where their comparative advantage lies, and country 2's comparative advantage would obviously be in producing Y. Okay, so the answer would be B. Right, 27. Okay, United States imposes a 30% tariff on imported steel. Okay, I think Trump announced that he was doing that just yesterday, actually. Okay, so what effect is this likely to have on the total revenue Japanese producers earn from steel exports to the United States and the price of Japanese steel to Europe? Okay, so it's almost helpful to think about a sort of tariff-style diagram here. So if I just quickly draw that out, just to show you how this would look. We're going to have the supply of Japan here, and then we'll have the supply curve for the world, for the US, sorry, and the demand for the US. Okay. Right, so what's happened now, of course, is that a tariff has been imposed. So we've got supply of Japan plus the tariff, and so therefore we can see that as a direct result of this, the actual level of consumption has fallen quite dramatically. So the US was consuming between Q1 and Q2 in imports originally, but now the level of imports has shrunk quite substantially from Q3 to Q4. So therefore we can see that now with these two price levels, we've got a contraction in the amount of demand, and further to that, the US makers are now increasing their production of steel. So therefore Japan is certainly going to earn less revenue. So there's going to be a decrease in revenue. Let's just put that square for the camera there. Okay, so there would certainly be a decrease in revenue taking place here. So we're led through to C or D. Okay, and what effect on price received per tonne for steel exported to Europe? Okay, well, the likely impact here is because there is a reduction in the amount of steel going to the US, there will be therefore an increase in the amount of steel available which would be able to be shipped to Europe. So that would shift the supply curve to the right, so that would therefore give us an answer of D. Okay, right. So let's have a look at the next one. 28. The government increases income tax with a view to reducing a deficit on the current account of the country's balance of payments. Okay, so government increases income tax with a view to reducing a deficit on the current account of the country's balance of payments. Okay, so this is really an expenditure reducing policy taking place here. How might such a measure do this? Okay, right, is it by discouraging future foreign direct investment? No, that's not the way in which this would work. Okay, so next one, is it by increasing government tax revenue? Okay, well, really, this is trying to trick you into assuming that the current account is to do with the budget deficit, and it's not. Of course, this is more about trade flows and investment income flows. So therefore, no, that is not going to be the answer. Many students will put that because they will confuse a deficit with the budget deficit. Okay, so just be aware of that trap. Is it C, by reducing desire for pay rises? Well, no, that doesn't really make sense because you'd have an increased desire for pay rises, certainly if you're paying more tax. And finally, D, by reducing the opportunity for firms to sell in the domestic market. Well, yes, this is entirely plausible because it means that consumers have less income to spend, and that's likely to mean, certainly with the UK economy, that they would spend less money on imports then. It will, of course, conflict with certain macroeconomic objectives, though, such a policy. Okay, so the diagram shows the demand for sterling and the supply of sterling in the foreign exchange markets. Other things being equal, if UK interest rates decrease, what is likely to happen to the demand and supply curves in the diagram? So if UK interest rates decrease, what is likely to happen to the demand and supply curves in the diagram? Well, the first impact is likely to be a reduction in demand. So demand would fall immediately. As soon as this is announced, there would be a reduction in demand. Now, further to this, if UK interest rates decrease, the actual supply, the available money in the market will actually increase. And so therefore, there will be an increase in liquidity as a result of this. Okay, as more money is taken out of savings accounts and so on. So therefore, we could see that we would end up in such a scenario here. Okay. So other things being equal, what is likely to happen? So we can see that the demand curve has shifted to the left. Okay, so we've got A and C, and then we've got the supply curves. Well, the supply curve shifts to the right. Sorry, so I need that on A and C. So therefore, the answer would be A. Sorry, C. What am I talking about? So the answer is C there. Okay. So we've got a shift to the left of the demand curve and a shift to the right of the supply curve. Okay, last one. So a developing economy. Let's just get that in focus. Right, a developing economy specialises in the production of coffee. Okay. What is likely to be the main determinant of changes in the country's standard of living, okay, in the short run? Well, we can see that we've got a certain amount of primary product dependence here. Okay, so with that primary product dependence, we know that they're likely to import consumer goods, Western style goods, and so therefore what's really important is going to be the index of export prices to the index of import prices, which is of course our terms of trade. Okay, and they need to be able to import those consumer goods with positive income elasticities of demand. Okay, so no, it's not going to be the birth rate, certainly not in the short run. The rate of inflation is plausible, but remember that the terms of trade is also affected by the rate of inflation. Okay, rate of migration, no. Well, it's certainly the terms of trade. Okay, all right, because they're primary product dependents, they therefore need to get secondary manufactured goods from abroad. Okay, right, thanks guys, hope that was useful.